In today's world, many people prefer growth investing over dividend investing. I understand it because growth investing has done well in the last few years, correct? C Limited, for example, is a high growth tech stock and it did a 10x in terms of its share price, gaining more than 1000%. But recently, share prices of many high-tech growth firms have came down and some investors have lost more than 80%. Dividend investing, on the other hand, you're not really too excited about prices shooting up too much. Of course, if it does come about, that's definitely welcomed. Some examples: ExxonMobil, the biggest oil giant, with a dividend yield of 3.17%, is gained 42% over the last 1 year. How about ASEAN's biggest bank, DBS? DBS has grown in the last 5 years 31.34% and it pays a dividend yield of 4.10% right now. You're looking for sound companies that can produce you dividends and compound them over time. If you get $1,000 in dividends, then you reinvest it for more and more shares, you know that you're actually building up your wealth for the long term. It's more of the slow and steady game, and as you know from the story of the hare and the tortoise, you kind of know who actually wins in this race towards financial freedom. So if you're keen to find out on how exactly to compound and really snowball your dividends for your own financial freedom journey, I have everything prepared for you, and continue watching on. Hi guys, welcome back. Let's get started. How it looks like in the dividend building journey starts like this: $100+. Then it becomes $500. Then it becomes multiple $500 and hopefully multiple $1,000 start coming in. Dividend investing is really the one true passive income, because when you own real estates and you collect rental income, there's actually still some work to engage an agent or to manage the tenant itself. So dividend investing is really passive in many ways. You just sit back, own the shares and collect your money. One step further in compounding your dividends is actually to use scrip dividends. An example is Mapletree Industrial Trust, where it actually pays scrip dividend and me as a shareholder, I actually subscribe for it. Sometimes these are priced at a discount to the current share price. That is why if you see in my own statement, you realize that there are some odd number shares over there. In Singapore, shares are traded on a quantity of hundreds. And with the next scrip dividend, hopefully I can round this up to a nice 100 number. I'll touch on this in a future episode, so stay tuned for it. But you're here today because you want to see the power of compounding, correct? Dividends are great. And if you compound dividends, that is really where the magic happens. Albert Einstein has this saying, compound interest is the 8th wonder of the world. And this graph really depicts how it looks like. If you have $100,000 today as capital and you invest it with a 4% dividend yield, in 20 years time, you have collected $80,000 worth of dividends, correct? $4,000 each year for 20 years, $80,000. That is depicted in the blue line, your total $100,000 plus $80,000. Do you know that if you reinvest these dividends, you can actually get an extra $40,000 more, because your total portfolio with compounding will now become $219,000. Now the first part of this magic is actually in the reinvestment, the compounding. And if you think a bit deeper, it actually isn't that difficult. In fact, you can actually achieve the same results when you buy a treasury bill, a fixed deposit, or a bond. And all you need to do is just reinvest that coupon or the interest that you collect. It is not bad, but it's definitely not a lot. That is where the second part of the equation comes in. And it starts with this question: what if the company that you invest in can grow its dividends? Let's look at Coca-Cola as an example. Back in 2010, dividends were around 90 cents. But in 2019, dividends have risen to $1.60. The latest annual dividend for 2022 for Coca-Cola is actually $1.76. So actually for the last 10 years, Coca-Cola has actually grew its dividends by an average of 6% per annum. If you were to compound all the cumulative dividends you've collected from a $10,000 investment, this will be the actual graph itself. Very beautiful, correct? An escalating curve up. And if you extrapolate this for another 5-10 years, you realize that number could really get very big. But let's take a more modest and conservative expectation to things. If the company you invest in produces 4% dividends and is able to grow its dividends by an average of 4% per annum, this could be what you could be experiencing. You see over there that the green line is your $100,000 capital. If the company you own only produces dividends but is unable to grow it, you actually reach that red line, which grows your total investment to $290,000. That is something we covered earlier. But if the company you own is able to also grow its dividend over time at a further 4% per annum, you realize that your total investment now can become $466,000. Now, that's an extra $250,000 on top of the usual compounding of interest, correct? And all it takes is just 2 steps of the formula. The first is to compound all the dividends that you've received. The second is to look for a company that can actually grow its dividend also. And this brings the total compounding of returns to 8% per annum. There are actually many companies out there that can grow dividends just like Coca-Cola. Typically, these companies have a business mode. And what exactly is a business mode? Is it a competitive advantage? Actually, it's more than that. It's a sustainable competitive advantage. Take for example McDonald's or Pfizer. On the fast-moving consumer goods segment, Nestle, Kimberly-Clark, Johnson & Johnson, you realize these companies, they have repeated business, correct? Once they raise prices, customers don't run away. More than that, they've actually exhibited consistent high margins in their business and they don't need to yield to competitive pressures too much. What about for the Singapore space? You can actually look at Sheng Siong. And as you can see over here, the gross margins of their business have been steady. Suddenly, getting to $1 million is not impossible, correct? If you were to invest $225,000 as a starting capital, in 20 years time following this formula, you will get past that $1 million mark. At this moment, you may be thinking, I don't have such a big starting capital. What is another formula that I can follow? I've actually just prepared for you. But before that, let me smash the like button, especially if this message has helped you see how to build finances in a different light. And as always, smash the subscribe if you like content like this. Now, if you have monthly savings coming in from your income, and you're serious about building something for your retirement, it is definitely possible to get there. But you need to follow a pace that you're comfortable, and I'll show you a possible template. What if you're able to invest $2,000 per month for the next 20 years? Your capital will be $2,000 per month times 12 times 20, correct? Which means a capital of $480,000, depicted in the green line at the bottom. If you were to compound all your dividends and also identify a company and invest in it long term that can grow their dividends, you could follow the path of the blue line on top, which will get you past $1 million. Now, suddenly, there is no need to speculate, correct? We're following the tortoise and hare method, whereby there's no need to sprint and come crashing down. It is just a focus on stable, predictable companies, which are also businesses that you are owning, and reinvesting every dividend that they can pay to you. If the share price appreciates, that's just a bonus. That is why Warren Buffett has mentioned that he doesn't mind if the stock market closed for a few years because he's not looking to trade in and out and speculate on whether the share price will surge up tomorrow or not. And since you start with me to here, let me show you a quick glimpse of my own portfolio. Over here, you realize there are small cap industrial players, REITs, and also real estate companies. I will touch on it in detail in a sequel, so again, smash the subscribe, stay tuned for that. I have nuggets of wisdom that I'd like to share with you to help you in your journey. And as you can see at the bottom right hand side, you realize that total dividends quite possibly are more than $22,000 per year already. Hopefully by showing you the path, you will be inspired to start your journey today. And as always, the formula is firstly, reinvest all your dividends. Secondly, invest in a company only when it's able to grow its dividends over time. And last but not least, start today. Hopefully this message catches you at the right point of time. Thank you for watching to the end. As always, I have this to recommend you. This is actually where I cover about how investing can really beat inflation. If you haven't seen it, I think these two topics relate to each other, and I think that can help you also in your journey. With that, sign off here and see you there. Take care as always. Goodbye.